Welcome to our Rational Radio for today. We have got, as you can see on screen, two good-looking gents, Wilhelm Hertzog and Mark Ingham. I'll give you more information on them in a moment. And before we forget to tell you that our special CEO guest today is Charles Savage, Stuart Lohman. Yeah, too much long weekend. Line talk. I was out in the far north with good friends this weekend. There weren't too many lions, but thankfully, but there were lots of relaxation. But Stuart Lohman, our general manager, is with me in studio. He can put on your camera so they can see that you actually hear, Stu. There we go. Okay. And he'll take us through the tech, just to make sure that everybody can hear us. Excellent. And they know, and then you know also how to pose your questions, Stu.
Excellent, thanks, Alec. Just on the control panel on your right, on the right hand side of your screen, there's a little #5 button. If you can hear my voice loud and clear and see 4 gentlemen pictures in front of you and a presentation. Excellent, Alec. We've got some #5s coming through. That's lovely. We do like to keep it conversational. I know Alec likes the questions. If you can get them in quite early, that always helps. There's a little questions drop down on that same control panel. Please put your questions in there as early as possible, and then Alec can pass them on as we go through our discussion. But all good this side, Alec.
Brilliant. Okay, so the questions will be posed there. Stuart will pick them up. In fact, you know what? I'm going to mute you, Stu. Okay, and I'll pick up the questions. Easy enough to see. And just to set the scene a little bit, Wilhelm, we've known each other for some years. You were the partner at RCM with Piet Viljoen. Are you still very much a value investor?
Absolutely. I mean, look, value investing, everyone likes to call themselves a value investor, and everyone wants to buy assets for a price below fair value, and that's what everyone tries to do. So I think value investing has a connotation of buying low PE, low price to book, high dividend yield stocks. We do like to take a bit more of a flexible view of value than just that. But certainly, fundamentally, at Rosendal Partners, myself, my colleague Paul Whitburn, we try to buy assets for less than they're worth. But I guess what an asset is worth is like beauty, it's in the eye of the beholder. And that's really where the art and the judgment comes in. But certainly, would still unequivocally call myself a value investor today, yes.
And also very independent thinking. And that's why we're so good to have you on the show today.
Well, look, I don't think there's much original thought really in life and in the world out there. Most of what goes through as original thought is something which someone has thought of before. But certainly, as a firm, like to be independent, like to call it almost speak truth to power, if one wants to put it that way, and really go with the facts and the evidence as opposed to just the intuition and the sentiment and the flavor of the day. That's certainly how we invest money. We think that independent thought and being able to distance yourself from the crowd, that really is key to long-term investing success. So we've really set up our firm, Rosendal Partners, in a way to encourage that and to facilitate that, because it is often very difficult in the investment management industry because of career pressures, because of client pressures, to really do the rational thing in times where others are irrational and where irrational behavior seems to be rewarded. So we think it's critical to have the right firm structure to facilitate the correct frame of mind and the clarity of thought that is required for long-term investment results.
Well, someone who's been around in the long term, and I think we've known each other for a quarter of a century easily, is Mark Ingham. Lovely to have you on the program today, Mark. We will be talking in a little while with Charles Savage, and I know you know Easy Equities pretty well, but you're on your own now, and Ingham Analytics, a independent research house. How's it going? Are you getting support from the public?
Yes, we launched last year, Alec, and it was 2 steps forward and 3 steps back. I think, as with all these things, that we've got a growing following. It's paid for research with a difference. We believe in easy sort of accessibility, and I think that speaks to Charles's methodology as well. And then my full-time job is running funds for a family office around the world.
The Labner Group, our dear friend, late friend Bertie Labner, and the huge work that he did in South Africa. And it's nice to see that their money is in good hands, because with Africa Tikkun, there's a big lots of mouths to feed, thousands and thousands of mouths to feed. I'm sure that you get quite involved in that side as well, Mark.
We try and keep a division of labor. So the investment side, which is Lubman, is a separate company from Africa Tikkun, and so we look at specifically at listed and non-listed assets in the family office environment. So my focus is principally there. The ethos, as you well know, Tikkun, Alec, is very much a hand up rather than a hand out, and I think that sort of philosophy is very important, particularly in a country like South Africa with so many challenges. And the self-help ethos, I think, is very useful there, and I think that organization particularly is doing sterling work, and there's a template, I think, for other organizations of that type working within a family office environment. Clearly, a family office, and Wilhelm will know this very well, you're multi-generational. So you're not looking at making a quick buck today, and clearly common sense, a lot of in-depth research, proper analysis, and not getting carried away by the crowd is quite important, especially at a time like this in overseas markets, and particularly in the United States, where you scratch your head as to where people get the valuation numbers that they do these days. So we tend to look through the noise.
We've been doing quite a bit of work on the US IPOs, Snowflake, etc., etc. And I don't know if you guys have come across this new concept of check-based companies. So in other words, some clever guy sets up a shell company and you just send them the check. And there's been hundreds of millions of dollars that have gone to these guys in the anticipation that they are going to find companies somewhere else that they can invest in and then bring them into that shell, which is extraordinary. Wilhelm, it sounds a little bit like a bubble type philosophy, but I'm sure there must be some logic to it.
Well, I guess it is probably a sign of where we are in the cycles, in market cycles in the US, that these special purpose acquisition companies, as they're often referred to, are managing to raise such vast amounts of money. And then companies are essentially reverse listing into these vehicles and thereby bypassing many of the typical checks and balances and corporate governance requirements that is imposed on companies when they list via the traditional IPO route. So it is sort of it seems to be a bit of a backdoor way for companies with questionable corporate governance, but who are in high demand amongst the investment public to get a listing. And sure, there will be some of these SPACs raised by reputable investors and great capital allocators who will find the great deals, and there will no doubt be great successes. But there will obviously be a great deal of unscrupulous operators trying to take the investment public for a ride through these vehicles. And it's quite interesting that you mentioned them, because we, of course, in South Africa have our fair share of these types of businesses listed on the JSE as well. There are numerous, I mean, in South Africa, we call them investment trusts, and we think of, I mean, there are numerous examples. And in South Africa, almost bar none, they're trading at deep discounts to the value of the underlying assets. We own a number of those in our client portfolios. And this is sort of the mirror image of what one sees in the US, where people are willing to give, where investors are willing to give operators and capital raisers vast amounts of money, and even sometimes, I'm sure, pay a premium to the underlying NAV for access to these investments that these companies are making. In South Africa, I mean, people can't give the shares of investment trusts away, and no matter how good the underlying assets are, they, through the bank, they're trading at deep discounts. So really, almost the polar opposite of what one sees in the US is what we're facing in South Africa.
It might suggest that there's an opportunity there, Mark, because what happens in America If America gets the sniffles, we get pneumonia. Maybe we will get pick up on this trend, and then these cash shells or these shells with that are trading at deep discounts will start realizing at least their fair value.
Yeah, we've had similar experience before with what are referred to as SPACs, special purpose sort of, companies, where it's effectively a cash shell, and you're given 2 years in which to deploy that cash sort of productively, or you give it back. So this is a variation on a theme. We've had 1 or 2 in South Africa. They haven't gained traction terribly much. Capital appreciation was a more recent one, where they managed to acquire tech assets within that window. And those assets are very interesting, and I think over time will do well. But sadly, as we see with many smaller cap companies in South Africa, I was looking at the figures just over the weekend. Our JSE is up about 20%, it's down 20% in US dollars, give or take, for the year, and that's thanks only to a handful of mega cap stocks that have little or nothing to do with the South African economy. And you know, Charles is a very good example of this, where you've got excellent companies that are unloved, and so the challenge in the JSE environment, where many stocks have probably become uninvestable due to these factors that have just been mentioned. I think if we did get confidence returning and a line of sight on the future, particularly in a governmental policy environment, then you know, this is a very good vehicle for that, and it does entice those who are entrusted with those funds, hopefully, to put them to good use. And therein lies the challenge in a low to no growth economy.
Surely, though, Wilhelm, before we pick up with Charles Savage from Purple Group, and best known as Easy Equities, their operating arm, or one of their operating arms, surely if you take a Buffett approach towards the South African market and you close it down for 5 years, you don't worry about the big picture. You look at the individual companies. If they're trading at huge discounts, and the biggest of them all, Naspers, which is trading at a 50% discount, just to its 10-cent shareholding, let alone everything else that it has around the world, then you would think in 5 years' time, you'd be a happy person.
I tend to agree with that. Obviously, it depends on where South Africa finds itself in 5 years' time, because I think as value investors in South Africa, many have had their fingers burnt over the past 5 years by investing in SA Inc. type of businesses, where valuations have been cheap for a good number of years, I would say, if you look at headline valuations, price to NAV, PE ratios, that type of thing. Yet South Africa's macroeconomic environment has been so diabolical that that this value really hasn't had a chance to rise to the surface. It's just been so tough for South African domestically focused businesses to make headway in terms of profitability and growth, that effectively these assets were value traps if one bought them 3 years ago or thereabouts at what already looked like low prices at the time. So I would, on balance, agree with what you say, that yes, if the South African market closes down for 5 years and you buy these assets, that on balance you do well. But one does require the SA economy not to go dramatically backwards from where we are today. We need some measure of leveling out, bottoming out, or conditions to stabilize. Otherwise, it'll potentially still be a case of value traps being bought today.
And very, very few exponential companies on the JSE, and that's where all the action is happening if you dig down into the US markets. But one potential exponential company, and certainly they have been growing in this way, is in focus today. And Charles Savage is the chief executive and founder of Easy Equities. Charles, I'm going to just switch your, I think maybe Stuart can just switch, well, let's switch on your camera. Okay, there you are. Good to see you. And also very good to be talking on this forum, not about horse racing, Charles, because that was what we were chatting about to a large degree last time. That whole story, the Pumalela story, now does seem to have settled down, so we won't go into too much detail there. But I was just looking through your CV, and you can see it on screen there, that you're a bit of a sticker. and you started Global Trader 26 years later. That is still part of your business. Then you started Easy Equities in 2014, and you're still there. Is there nothing else that interests you outside of financial markets and horse racing?
Yeah, well, you added in the horse racing. So nothing outside of horse racing and financial markets from a business perspective. Yeah, I am a sticker, man. I think I found a great marriage between my love for technology and my love for finance in the group. And I think, importantly, coupled with shareholder grouping, that really just inspired me and backed me to do things differently. So once you find those kind of places and you find your passion, then it's very, very likely that you're going to stay for a long time.
Mark and Wilhelm, can you hear Charles clearly enough?
Reasonably well. There was a bit of a breakup, but it's okay.
Okay. All right. Well, let's just go into the whole exponentiality aspect of Easy Equities. And maybe before we get there, 2019, you were looking to change the name of the company, Purple Capital, to Easy Equities. What happened there, Charles? Because I see there was a circular. It's still on your site. Are you still in the process of doing that?
Yeah, I think what happened was that there wasn't a natural fit between what was GT247.com and the Easy Equities group. And I think, for people to understand the two businesses, one is a speculative day trading business and has been around for a long time. And everyone knows what it does. But that business, 80% of its customers lose money, 20% of them make enough to keep their heads above water, and a very small percentage, 1 or 2%, actually make considerable money out of day trading. And it's always been at loggerheads to the principles or the mission of Easy Equities. I mean, Easy Equities is an investment platform.
Charles, we're losing you.
Long holding.
I think we're going to switch your video off just to make sure that we can actually hear you.
Create outcomes. And so,
Charles? No. It sounds like the bandwidth in your home is under a bit of pressure at the moment. Yeah, we switched off your video. Perhaps that'll help a little. Yeah, it should be better. Okay, keep going. Yep.
Sorry, man, I don't know what's happened. Yeah, so it really was just about the fact that GT247 doesn't fit comfortably into the Easy Equity storyline and the purpose of that business. And so we've sort of reflected on whether or not that should be a long-term part of the group. And until we've thought about that more holistically, we postponed the name change until we've made that decision.
Great. Something else, and I was looking through here at your market cap. Now, I'm not sure if you can see that on the screen, Charles, but it's very indicative. This is a 10-year graph, and it's the market cap of Purple, which shows that you got to around 800 million in late 2014, and then it went all the way down to 200 million for most of the last 3 years, and then suddenly you've caught fire. What's going on there? Maybe you can talk us through that, because I guess investors looking at this are saying, first of all, damn it, we should have bought the shares during that 3-year high doldrum period. But on the other hand, if it's gone up so quickly to 800 million in the past, is it not going to be doing the same thing in future? Maybe you can just give us some context.
Yeah, look, I think the storyline of Easy Equities, which whilst it's been around for almost 6 years now, hasn't been well understood. And I also, to a large extent, think that the average South African investor isn't necessarily a growth investor. So, I think if this was listed in other places like the US or Australia, that it might have got more support earlier. But I think as the numbers have unpacked, and as we've told our story every 6 months through our financials, it's become more and more obvious for people to follow. And as those numbers have surfaced as being exponential, the share price has responded. And that momentum shift really happened into our results in February, where the prospect of profitability suddenly became tangible to, I think, to potential shareholders, whereas before the losses were significant in the context of the size of the group. I mean, if you go back and look at the losses over the last 2 years, in the context of the size of the market cap of the group, they were sort of 10% of the market cap. And I guess there might have been a lot of nervous sentiment around the fact that we had these large losses against a very small market capitalization. But when it became very clear that we were going to be profitable, and it was signaled in our February results, I think the market confidence responded positively, and I think people are now seeing a very different future for the group. And I would say the final element of it is that the Capitec deal, which we announced post our results, I think gave everyone confidence that the runway for future growth is also very well secured, given the fact that we're going to be entering inside the Capitec banking app and have access to those customers, all of those online mobile customers, for free, essentially.
Wilhelm, apart from, well, maybe you did buy the shares around the 20-cent level and now looking at it 70 cents. What's your thought about what Charles has just told us? And maybe you have a question.
I mean, it sounds very exciting. I think this partnership with Capitec, certainly the broad reach of Capitec in terms of their client base and all that, definitely, I think, would, to me as an outside investor, and I know Purple Group somewhat, but I'm not intimately familiar with the business. I mean, it certainly sounds exciting. And I think that discount brokerage model and providing cheap access to financial services for broad swathes of a country's population, that has historically been a good business model in most countries. So I can certainly see the potential of the business. I think the interesting perspective and challenge, and I'd love to hear Charles's view on this, would just be that I think in many countries, and I guess one sees that in the US, discount brokerage models and pricing on discount brokerage platforms have been driven down to almost negligible levels, and trading is offered for free on many of the prominent and some of the larger platforms. So it does seem to become a race to the bottom longer term. So as a small player with maybe less scale than some of the incumbents in the industry, how does one manage that dynamic of potentially a large, well-funded competitor just throwing caution to the wind and saying, look, we're offering trading for free, come into our arms? How does maybe a business with a smaller balance sheet deal with that type of scenario should it arise?
Yeah, I mean, it's a good insight and good question, but the truth of it is that the free trading model doesn't work anywhere else but in America. And this is something that, you know, I've chatted to other fintechs around the world. The difference in America is you have a competitive exchange environment where the flows are valuable to the various exchanges. So whilst you're offering free brokerage, you can sell your flows to high frequency traders and to the exchange and onto the exchanges. So you are, whilst you know, it's free, someone's getting paid for that flow. Those models don't exist outside of America. There are pockets of it, but they're not mature and they're not liquid enough to support a platform of the size of Easy Equities. So I don't see that it being a sustainable business model outside of America for now. And I do think that those that are trying it outside of America are going to come under their own pressures in terms of creating their own sustainable business model. The secret, though, in providing a low-cost offering is in order to be sustainable, you have to have the lowest cost of acquisition for your customers. And that is the key number that everyone, you know, needs to track and measure. And for a lot of these fintechs, some of them who compete with us, and I'm talking locally and globally, they haven't been able to drive their cost of acquisition down to the point where the business model is sustainable. The one that I looked at most recently was Acorn. You know, millions of customers, cost of acquisition still very high, and revenue that comes from those customers very low. So that they're going to have to get something. They're going to have to change something. They're either going to have to charge more, or, you know, radically transform their marketing approach. Now, in Easy Equities, just to give you some insights, our cost of acquisition, our target when we started the business was 250 Rand a customer. And to contextualize that against the industry, the average cost of acquisition for a financial services firm in South Africa is around 2,500 Rand a customer. So we backed ourselves into quite a bold cost of acquisition, quite a low cost of acquisition. In this financial year, our cost of acquisition was just under 50 Rand, 49 Rand a customer. Now, given that cost of acquisition, the ability for us to generate a return from our customers in a very short period of time is substantially increased. And the problem a competitor will have is that, yes, you can come in and you can try a zero cost brokerage, but if you don't get your cost of acquisition right, then you won't create a sustainable business model. Now, the secret in our business model is how do we create this low cost of acquisition? And it's all in the fact that all of our customers, well, not all of them, 60% of our customers come from other customers. So it's all referral business. And we've created a brand that South Africa's fallen in love with in a very short period of time. And that can't be replicated by either money, throwing marketing money at it, or two, technology. A lot of people have said to me, Charles, if I gave you 200 million, could you recreate the business? And the truth is I wouldn't even try, because there's some magic in what we're doing that is demonstrably evidenced in this love that our customers have for the brand and the business, which has created this huge wave of referral business, which keeps us growing faster and faster each year, because it is a snowball rolling downhill. But I think locks out the competitive threat to a large extent. It's not to say that it doesn't exist. And I'm not trying to be arrogant to say that, we're not going to get competitors, but it does significantly widen the moat for anybody else who needs to enter the market, because it isn't just about technology and it isn't just about the cost. We charge a fair price for our services, not free. And everything we do is about ensuring that the barriers to entry for first-time investors is fairly proportioned, whether you're a R1 million investor or a R1 Rand investor. So for me, low cost or the lowest cost is not a defendable differentiator. And some of the business models that are deploying them are going to go under. Many more are going to go under than are going to succeed, in my view. And so for us, we're focusing on ensuring accessibility and fairness of the price or the cost of investing is managed. And then most importantly, that our customers love us and keep referring their friends and family, because the more they do that, the faster we grow.
Charles, before I ask Mark to pose his question, I just put this up on screen because I'd love to get an update from you. This is from your annual report to end August 2019. You did bring out interim numbers, which showed that funded investment accounts, that number of 111,000, went up to just under 200,000, or that was before the Capitec deal. Where are you sitting now?
Yeah, so funded investment accounts is 272,000, somewhere there, across the platforms. And that is Capitec hasn't gone live. So Capitec will go live in October. Our current acquisition rate is roughly about 1,000 customers a day. Interestingly, during COVID, and we're obviously still in COVID, but lockdown COVID, if you like, those numbers were up at 2,000 customers a day. So people definitely had more time on their hands to do these kinds of things. But pre-COVID, so into our results end of February, those numbers were 300-400 a day. So essentially what you've seen in the group is that it had extraordinary growth in COVID, which has resulted in what I would say is a sustainable growth rate now without Capitec that is more than double what we were growing at in February. So, we've experienced exponential growth in a 6-month period, and we've still got that, unknown runway of what will Capitec produce for the group.
Mark?
Yeah, Charles, it's interesting. There's an old joke, it takes years to become an overnight success. And I think your results this year will probably be a pleasant surprise for the market. Certainly if the half-year results are any sign, it's making positive momentum. I think, Charles, what's interesting here is that although one looks at it in a more sort of parochial JSE frame of reference, in fact, what you've created over the last few years is scalable. And you're probably reaching the point now where that scalability becomes global. And I think what's quite interesting is that you've introduced a lot of investors, small investors, to a global market for investing. If I want to buy a gold-backed ETF, I can go onto your platform and I can execute that with relatively little friction. So you've certainly opened up a universe to people, and I would suspect that whether you're based in Johannesburg or Timbuktu, it doesn't really matter. What you have is something that can travel, and your costs will not increase in relation to that. In other words, revenue is likely to grow at a rate far quicker than your cost of doing business.
Yeah, Mark, I mean, that's exactly right. These businesses have got a very high, expense, high watermark for expenses. And once you reach them, then the scalability is really, the leverage over the cost base. And, we've reached that point now. And I guess the question that beckons for shareholders, and which I have to direct, is what to do now with our profitability. Do we invest it in further growth? And if we're going to invest in further growth, where do we want to invest it? In South Africa, in Australia, in the UK, in America, in the rest of Africa? And, if I categorize the last 5 years, it was really about creating a platform that's satisfying a demand for a platform, or the need for the platform, which we can tick that box. The second part of it was to lock out distribution opportunities that gave us a defendable moat over any market entrant. And I've talked about some of that. Capitec's a great example, but we've also got other wonderful partners. I mean, we run the platform for Satrix now, and that's our platform, and that gives us significant access to quite a different market segment. I mean, the average age of our investors is 32. The average age of their investors is 41. So it marries their brand and our platform capability with a different market segment. And we're not finished locking out distribution. I would say there's one more deal to be done in South Africa, and I'm working really hard on that, and that's to lock out a distribution deal with a telco, because we think that that's a runway we'd love to run our products along. So I'll keep focused on that. But the next 5 years are going to be categorized by where else can we take this platform capability. To start with Australia, and that business is, I was on a call now just before this, and that business looks set to go live this week. And that's really exciting. The fintech ecosystem there is as competitive as South Africa, but very interestingly, the market setup looks identical to what we found ourselves facing when we entered South Africa. So when we started in South Africa, the largest stockbroker in South Africa in retail space was Standard Bank. They purportedly have around 70,000 active accounts. 5 years later, we've got 270,000 active accounts, and we're the biggest retail. And the same market dynamics are set up in Australia. The biggest stockbroker is a bank, it's CommSec. 70% of all retail stockbroking accounts they own, and we think we can apply some of the lessons learned here in beating them up in their own market space. The other reason Australia was interesting for us is we see it as a market entry to the rest of Asia. You can't run Asia from South Africa. The time zone is just too unfriendly. So we want to put a beachhead there, get that business profitable in a very short period of time, and then start targeting other regions. And then the one that I guess excites me the most and speaks the most to why we built Easy Equities is Africa. Africa is an untapped market opportunity. Not all markets are ready for Easy Equities just yet. But if you look at the ecosystem that we require to do business and our customers require to be in place to do business with us, the first is there must be low data costs, because otherwise the point of investing small amounts is going to be, dissolved. Second one is that there must be access to smartphone capabilities, high penetration of smartphone capabilities, because we don't build services for dumb phones. We're not going to go and spend money on USSD services. And that again, the penetration of those devices is really high and growing fast. And the first $10 smartphones in the market already. And then the third ingredient, which is the one that is missing in a lot of African markets, the ability to move money electronically must be easy. Because again, if that's not available, then there's no point trying to create an investment platform that sits on money moving freely. And so for us, the first market entry that we'll go into in Africa, outside of obviously South Africa, is Kenya. It's got all of the ingredients. And for us, the market opportunity is to go and take what we've done and see if we can replicate it in places that look more familiar or more similar to South Africa. And for us, our opportunity is Africa. It's right on our back door. It's in our time zone. There's much closer cultural connection between South Africans and the rest of Africa, and we want to do what we've done here elsewhere in Africa, and that's really, really exciting prospect. And then, finally, we will certainly look at other jurisdictions, and what's driving us in other jurisdictions is the lack of availability of our kind of financial services. So there is a lot of focus on what I would call first world fintech. There's a lot of places outside of first world that need this, where the need is required. And essentially, we want to go to places where you need more mosquito repellent, where our big first world competitors are almost too scared to go. And when they look up to say, well, where do we go next? We want to make sure we're there. So we're not, you won't find us in the UK, and you won't find us in the US, but you might find us in Eastern Europe soon, and you might find us in India soon, and you might find us in places that people have been, I guess, a little bit cautious to go.
Charles, that all needs money. And when Sanlam came in as a shareholder, it looked like you had the cash to pursue that very aggressive ambition that clearly you have. But I see from that the circular that is going to close now at the end of this month, that there's something in there about repaying Sanlam. What's going on there?
Yeah, when Sanlam bought 30% of Easy Equities for 100 million, they put a protection mechanism into the deal, which was to protect them against the valuation being wrong. So essentially, you can imagine 3 years ago now, trying to value a business which at the time I think had 10,000 customers, was losing 40 million a year roughly. And how do you put a positive valuation on that? So it was a well negotiated outcome, but an uncertain outcome. So in order to protect that valuation entry point, they had the right to give us back the shares, and we would have to then pay them the 100 million plus interest if they felt that the business didn't have the prospects that they believed it had at the time. Or the alternative is, to the extent that we couldn't repay them the 120 million, then they would get another 10% of shares, essentially lowering their entry price. Now, in the result, they're in quite a sort of shotgun kind of position, in the sense that they have to, if they do put it to us, anyone who had the opportunity to invest in Easy Equities at 100 million rand, 100 million for 30%, so sort of 320 million post-money valuation, anyone would bite their arms off at doing that. So the likelihood of them exercising that option, I think, is low, but I don't know what they're going to do with it. It expires, the termination date is 6 months after the 17th of November, and they have that right to put those shares to us, but there's no turning around. If they put the shares to us and we raise the capital and pay them back, then they're out. So quite a dangerous game to play if they like the investment. And Sanlam have been a wonderful investor. Actually couldn't ask for a better investor. They've given us great access to market. They've helped us build our runway into distribution. And so I think it's a very unlikely event. But the reason we had to put the circular out is we have to do the housekeeping as if it is going to occur in case it does occur. So I personally don't think it will occur, but time will tell. And then the other reason is that just we've only got 1.2 billion of authorized share capital, and we've got obligations in terms of share incentive schemes, and also a BE deal that we did 2 years ago that over the next 12 months are going to require more shares than are available in our authorized share capital. So that was the other reason behind it.
Wilhelm?
Yeah, Charles, I think interesting aspect of your business is as you mentioned, that the GT247 and Easy Equities, and being sort of two very different businesses. But I imagine they were both premised on the same underlying fundamental principle of offering readily available, low-cost access to markets. GT247 has seemingly had its trials and tribulations and is now on the up again after some difficult years. What have you learned from the GT247 business that you carry into running Easy Equities, or are the two businesses not as as similar as I imagine them to be. You highlighted the differences earlier, but as I said, I think the underlying premise is probably similar or shared, or is that not necessarily the case?
No, look, I mean, they leverage off each other extensively. I mean, the tech, for one, is identical in the back office infrastructure and what's required to run the platform. But the key difference is that between 7 and 10% of individuals, investors, become traders or play both roles. Some people are investor and trader. So the market opportunity for GT247 is 1/10 of the market opportunity that is presented for Easy Equities. So Easy Equities has a much greater runway. It therefore has much greater scale requirements in terms of the tech that needs to serve those customers. And the other key difference is the lifetime value of a GT247 customer is time bound by roughly, it's about 13 months. They literally lose their money within that period. So you go out, you're having to replace your customers essentially every year. You've got to go out and build a new client base every year, it's a hamster wheel. It's a tough business. It's for young guys much younger than me. And in Easy, your customer lifetime value is impossible for me to tell you, because I don't know how long 32-year-olds are going to continue investing. And that's really determined about how long they're going to live and how long we can keep them happy. But it's much longer than 13 months. So those are the sort of key differences. The question that I guess plagues me and my team is, because we are the graduation, we're the university for investing. If we're going to graduate these traders, the 7 to 10% or 5 to 10% of traders, do we stay aligned with GT247 and keep it in the group? And it will naturally benefit from all of these graduates, or do we eventually divorce ourselves from the trading business? It's not a business. We will never be the best in the world at GT. We missed our time. We were well ahead into 2008, but we got heavily beaten up in 2008, and the competitors ran past us. And those are places like IG and Saxo and FXCM and a whole lot of others that are just better at it globally than we are. But in Easy, we could be the best in the world at opening up new first-time investors and creating a new marketplace for first-time investors. And at some point, the group needs to be focused around a single mission and purpose. It's been fine till now, but I think as we grow and as the demands of Easy Equities continues to grow, we're going to want to focus more and more of our time on that mission and purpose. So, my belief is that the two businesses will probably end up divorcing. There will be an exit of GT in time. If that's not going to happen, then the business needs to marry it more formally. And then I would change the brand and introduce it at the right time, at the right place for those investors that are seeking a trading destination. And as you can tell from the way I'm talking about it, it's not something we're fully baked on. We haven't come to a conclusion on it yet. GT continues to make a very healthy contribution to the group. We're in no rush to get rid of it. And it's definitely benefiting from the tidal wave of customers that Easy Equities is bringing. So for now, we'll keep thinking about it and see whether we fall more in love with it and then rebrand it within the group, or alternatively look to exit it and pay the dividends out to shareholders.
We've got quite a lot of questions here from the community, starting with John Hardy. He wants to know, why are there so many director sales of shares in Purple Group?
Yeah, I mean, look, you've got to understand that we've been in this, you said at the beginning, Alec, we've been in this a long time. And you've got varying degrees of service amongst the directors. Some of them have been here for a very long time and are also getting older, and so they need liquidity in their shares, and so they'll sell their shares to finance their lives, which is acceptable. It's not like they've been around for a very long time, and that's the real thing that's driving it. The other thing is that even at a management level, the management team have heavily backed themselves into the share, to the extent that I'll speak for myself. 99% of everything I own is in Purple. That's how much I believe in this group. that means that, if there are unforeseen events that I need to take care of in my life, then invariably I'm going to have to sell some purple shares to finance those. And so, whilst I wouldn't give that advice to anyone else, this is my baby. This is what I've created, and I'm confident in its future. So I have a very unrealistic distribution into the share. So it's tenure. It's driven by the fact that lots of people, a lot of the directors have been there for a long time, and they need to eat from their shares, and we don't pay dividends right now. And then the other one is that, certainly for myself, I have 99% in the share, and so sometimes school fees need to be paid, in which case I've got to sell a few shares.
Mark?
I think what's also disruptive, Charles, and which we haven't touched on, is RISE, which is retirement, investment, and savings for everyone. And that is very much in the philosophy of what Easy Equities is about. It's a joint venture. It, in fact, also seeks to reduce the cost of admin in this area, particularly at a time when markets haven't been going terribly far and when everybody's under cost pressure. That ease and cheapness of access is another important pillar of your business, and which is already contributing to the P&L.
Yeah, Mark, RISE is a lovely business. If I use an analogy for the two, Easy Equities is a line fisherman. It goes out, throws its lines out every day, and catches a few fish. RISE is a trawler, and it goes out, and when it catches fish, it catches them in very large numbers and large asset values. But it takes a long time to hunt those, schools of fish down, and you don't land them all the time. But the two businesses are so synergistic, because you've got Easy Equities that's just bringing in, customers every single day. And then alongside this, you've got this longer tail of acquisition, which goes out and seeks pension funds and with it their clients. And the two work perfectly. We can leverage the technology to deliver the same investment experience, just in the one case through a pension fund administration business, and the other one, for people who want to manage their investments for themselves. So it's a great example of how we can use the platform in other sectors. I think the thing that is potentially worth highlighting, and I would say the market needs to watch closely with us, is where else can this platform play a role? If we're building the most valuable distribution base in access to customers in South Africa, which I believe we are, and that's becoming obvious in the numbers now, then what other financial needs and demands can we service to that distribution? And that's a very interesting question. And in the outcome, I think there are lots of product and platform opportunities that will see us leverage this distribution into new profit lines. And a great example of that is Easy Properties, not just RISE. I mean, Easy Properties was born out of a survey that I did 2 years ago to my customers, and we said to them what asset classes are missing. And we thought that crypto was going to be the answer, and it was the second answer. And we ended up doing a JV with Michael Jordan and Earl Loxton and DCX to give them access to a crypto index, which is also doing really well. But the second one, the most in-demand asset, was actually residential property. Now, I would never have guessed that, but given the fact that our customers wanted it, at the same time, fortuitously, we were introduced to the Buffett Group, who are the largest owners of residential property in this country. And they came to us with a proposition to say, look, is there a way that we can distribute our properties into your customer base? So we, 2 years later, and probably about 4 million of capital now invested in that platform. We launched Easy Properties 3 months ago. To date, it's sold 30 million in property already. It literally sells out in a week. Last couple of weeks, it sold 12 million of property in a week. And it was EBITDA profitable in its first month, because it doesn't have this cost of acquisition. It just gets dropped in on the Easy Equities distribution base. And, I would guess that within the next, it'll do sort of be EBITDA positive in a full year at between sort of 8 and 12 million rand. Now, that's a great example of new product, new service, well aligned with the Easy Equities brand, where demand is proven, i.e. our customers are saying we want this, and we just drop it in. And the thing that I think everyone's got to think about is, what else can we do? The things that I'm thinking about is I've got a real problem with the life insurance sector in South Africa, in that I think it serviced the needs of the wealthy really well. But actually, I think that at the lower end of the market, the younger end of the market, there's a need. There's some radical changes in the product, the way it's sold and distributed, and I think that's an interesting opportunity for us in Easy Life. I also think that margin lending against a securities portfolio should be the lowest cost of finance that anyone can get, and so we can displace a large portion of the micro lending market by lending at a much lower rate, let's say 50% of what they're paying or even lower, against the equity portfolios responsibly, so that it doesn't destroy the investment outcomes that they're seeking. So we'll ring fence it to a limited amount of their portfolio. But those are just two examples of products that naturally fit into what we're doing, because our customers need them and want them, and more products will come. So I think that it's not just about the businesses that are already in the group. People have to think about what else we can do with this distribution. And that's exciting for me, because those that know me well know that the things I really enjoy is the innovation, the product development side, and then scaling the business opportunity. My team are much better at running everything else.
Edward Duplessis asks a question which is related, Charles. Is Easy Equities looking at the private equity market and making private equity investment accessible to investors?
Yeah, great question. And yes, I mean, crowdfunding, which I would, say is similar to private equity. So crowdfunding is definitely on our agenda. For us, we sort of did the maths around it, and we think we need to have 1 million investors on our platform. So we're sort of halfway there, I think. So within the next 18 months, we expect to launch a crowdfunding platform. Alongside that, we do help the Section 12J guys in raising capital for their sort of private equity vehicles. There's one that's going live, I think, at the end of October from Kalon Ventures, and we'll continue to support that segment as well. So yes, definitely, private equity is an asset class and sector that I think retail distribution would love access to. It's a great example of an asset class that is restricted to the wealthy. I mean, I've never been approached to invest in private equity, and so all the way down, nobody does. So yes, for sure, and it's one I'm passionate about as well, because frankly, raising money in this country is one of the worst tasks I've had the displeasure of having to go through. It's really hard to raise money in South Africa. It's not like it is in America. So if we can solve that problem and help VC get funded, then yeah, we want to do that.
I've got a lot of rapid fire questions, because it'd be good to let Wilhelm and Mark have their last questions as well, and we are running out of time, Charles. So perhaps some quick answers here. Lance Smith says, who's using your platform? Male, female, black, white, Indian, etc., and what's the average trade?
Yeah, so quickly, 62% male, 38% female, 99% black South Africans, average age 32, average investment, so average portfolio is 30,000 Rand. That's the average portfolio someone's running, but the average investment size is 2,500 Rand per holding.
George Rex wants to know, will China come onto the Easy Equities access map?
Yeah, we're looking at it now out of our Australian office. The Aussies also love investing in China, so the demand is there. We're looking at how and through whom, and yeah, definitely on our radar. It looks like Hong Kong first, so Hong Kong, China first, but then China possibly after Hong Kong.
Shaman Prem asks, would you recommend that long-term investors use 2 or more platforms to guard against one going under? I guess he's a bit concerned that you might grow too rapidly.
Yeah, look, I mean, security of assets should be forefront for any investor. We secure their assets by holding them outside of the group. They're in a nominee company, which is ring-fenced. The balance sheet of a nominee company is ring-fenced from the operations. And so we can't go, if we go under, we cannot do any harm to our customers' assets.
Andrew Lake asks, he says, if you have 160,000 Rand in global trader investment, would I be better off to cash in and move funds to your Easy Equities USA or Easy Equities Satrix?
Yeah, I'm not sure. Don't really understand the question, but I'll guess at what he's asking. If you're an investor, then Easy Equities is a much better destination for your money. If you're a trader, then GT247 is a better destination for your money.
Hilton Goodhead asks, what's the relationship with easy.com?
Nothing.
Okay. And Sean Griffiths wants to know, what's the biggest risk for Easy Equity customers?
What they invest in.
Not he adds up there if Easy Equities goes pear-shaped.
No. As I said, the assets are ring-fenced from the group and held in a nominee.
Wilhelm, your final question?
Yes, sure, Charles. I'd be interested. I'd understand if it's confidential, and it probably is confidential to some extent. But for instance, the terms of the Capitec distribution agreement, like the economic split between Easy Equities and Capitec, what part of that is more valuable? Is it what Easy Equities brings to the table, or is it the Capitec distribution network? So in a transaction conducted by a Capitec customer on an Easy Equities platform via the Capitec banking app, does Capitec take the lion's share of the economics, and or how does that play out?
Yeah, so firstly and foremostly, Capitec negotiated really hard to ensure that the client benefited a lot. So the client benefit is they get a 20% reduction in their transaction fee. So they pay 20% less brokerage. So that's the first point. The balance of the economics are then split between Capitec and Easy Equities, and we get the lion's share of those economics.
But isn't that, I mean, I've got a Capitec share account, and I know you guys are the cheapest in the market already by far. Aren't you then going to find some of those 273,000 account holders, presumably a lot of them are at Capitec, just cutting your brokerage?
Yeah, Alec, maybe. And if that means that they get a better experience of our platform, then that's fine. And it's the sensitivity to our brokerage is not as high as you would think. We earn our economics across the platform at various different transactions. So we're very happy that if that's the outcome, that they all move their banking to Capitec, then that's fine. We think the greater opportunity significantly is the weight of their customers joining. So, let's just say that all customers move to Capitec, and as a result, our income goes down, 10-15%. What is the benefit of having access to all of Capitec's customers joining us? And the obvious answer is it's much greater than 10-15% of our current income.
Sorry, Mark, before you pose your last question, this is one I just got to ask you. Is the JSE supporting you in any way, or if not, are you using other exchanges or playing with other exchanges? Because what you're doing has got to be making it is making a huge difference to the future of South African retail investing.
Yeah, we've collaborated with the JSE on several retail initiatives. We run, the one that comes to mind is She Invests, which is we work with them to do that, and we've done a couple of other things as well. But we're agnostic in terms of where the exchange flows goes, and specifically we deal through a prime broker, and we manage the prime broking relationship, ensure we get the best possible price, which we then pass on to our customers, and then we let the prime broker worry about which exchange at what price, and where he gets his liquidity from.
Hilton Goodhead, by the way, says that the Easy Properties icon on your website links to easy.com. That's why he asked the question. So I guess there's somebody there who's just put the wrong link in. Mark, your final question?
I think just closing remarks. We haven't much time, Alec, but I think a lot of effort and innovation is really coming through now. I think the partnerships that are being built with the Capitecs and others of this world are certainly coming through, and you're judged in life by the company that you keep, and clearly there's loyalty there from a growing platform of customers. And I think as this is a proudly South African company, we can only wish them well on their way.
Nice one, Mark. Nice way to finish off. Before we let you go, Charles, it's quite obvious that Mark is a big fan. We've heard that. I also saw in your breakdown of shareholding that Michael Jordaan's Montegray is quite a significant shareholder. So you seem to be making the right statements in the right area. Did Michael get a discount on his shares?
Michael's been a great mentor for me in the last few years, and as a result of that relationship, he's, I guess, gained confidence in what we're doing. He loves Easy. He loves the Easy story. We've got a great partnership with DCX with him, and I think he sees the future of finance in a similar way to the way I see it. And so, you know, that's resulted in him taking up a very substantial shareholding over the last few years. And no, he paid fair market price.
Final comment from you, Wilhelm?
No, look, I think it's been very impressive to see how Easy Equities has grown and the accessibility and savings that it brings to the market. So, I mean, all the best to Charles. We'll certainly be following the story quite closely. It's a fascinating business.
Let's see if we can get him on camera just for the last couple of minutes. Yep, there you are. You're back again. Stu, where are we going to be able to access the recording of the webinar?
Thanks, Alec, and thanks all. It was great, fantastic discussion. Alec, I put the YouTube link on the chat bar, which is on that control panel, and hopefully in the next hour or two, we'll be able to process the video and get it there. And then the team will obviously trim it apart, etc., and cut it up for the audio section on our owner. So, yeah.
Well, we look forward to that and to hearing more about the exponential story that is Easy Equities. Charles, thanks for joining us today. Good luck with your horse racing endeavors. And from me, Alec Hogg, and our team here at Biznews, thanks to Mark and Wilhelm for posing your questions. We look forward to being back with you next week. In next week's Rational Radio webinar, we have Mr. Hudson. What's his first name? From
Panda.
No, not from
Gavin,
Panda. Gavin, sorry. just lost my mind a minute. Gavin Hudson from Tongaat will be with us next week, and then in 2 weeks' time, we'll have Charles's shareholder, Paul Hanratty from Sanlam. He'll be in studio with us. Well, what do you call these things? Is it in studio or certainly on the GoToWebinar call? But make a note of those. It's for the next couple of weeks. But as Stuart said earlier, we will have Charles Savage's eloquence as well as those of our analysts recorded for posterity on YouTube in the next couple of hours available to you. Thanks again for joining us today. Until the next time, cheerio.